Are you buying data centers now? Are you building them?
We are invested in data centers in Asia and in Europe, markets that I think have some very different supply barriers than the United States, have a different demand profile as well, but really have some supply barriers around regulation, borders, energy restrictions, those sort of things that just make it a less frothy and harder to access market. And so I think you can invest with a little bit more conviction in the long-term supply-demand picture and probably with a little bit of a cap rate premium that gives you a little bit more margin of safety. We are also investing heavily in the United States in bank of powered land, securing the energy infrastructure that powers data centers if we're not taking the development risk downstream. Why do I say that? Because, look, I don't know where the mispricings in the ecosystem are. I'm sure there are some. If this is the first technology cycle in which no one loses a dollar, it'll be the first technology cycle in which no one loses a dollar, that it just hasn't happened.
Sure.
I think there are probably some really good bets out there that we're not making. And I think there's some really risky bets that we're not making. But my underlying challenge is twofold. One is I think the CapEx cycle that you're seeing in data centers today is almost by definition unsustainable. We are spending as much on data centers as we are on all other real estate put together right now. We're spending more money to house computers than humans. That's a pretty odd thought. We're doing that because there is an existential war amongst hyperscalers to see who's going to be the foundational LLM model of the future. And if you're Google, if you're Meta, if you're Microsoft, if you're OpenAI, you have to pay to play and you have to play to win. And so they are spending 60 to 75% of their free cash flow right now on CapEx for AI because they're in this arms race of epic proportions. But they're not all going to win that arms race. I don't think we need 7 foundational LLM models in the future. We have one search engine today, by the way. We have one email server. Sort of people tend to win these technology wars. And I think as it becomes apparent to participants that they are not the winner, you'll see them necessarily start to take their foot off the gas, start to harvest that free cash flow in a different way and reprioritize their corporate spending. And that's going to create an air pocket in the development boom that we're seeing today. I think that's almost inevitable. The question is, what happens when that happens? Do the leases all stay in place? Does the demand stay there? Does the cap rate stay there? Not entirely sure, which is sort of my second question as I approach the sector of sort of what is data center income worth? And I don't know the answer to that, but I can think about it in a comparative way. The prevailing wisdom today is that a fully leased credit tenant data center, with a hyperscaler is worth like a 6 cap. And, why? Back to our favorite question, why is it worth a 6 cap? It's got a premium to multifamily, but a discount to retail. Why? Why does it sit in that space of the market? And I think, the people who are bulls would point you to sticky credit tenancy, the high quality of income, the irreplaceable nature of the asset. And that all makes sense to me. But I think the bears would point you to, ongoing capital drag at the asset. How much do you need to reinvest in this asset when the lease is up to renew the cooling technology, to recondition the power, to upgrade the infrastructure? And I don't know the answer to that, but I know that Gen 1 data centers, the kind of data centers that were built 15 years ago for Yahoo and AOL, if you want to modernize one of those, it costs about half the amount of the data center to redo it. 50% capital drag every, call it 10 or 15 years.
I'm curious why the market is so focused just on hyperscales, whereas there's been a fair amount of research come out about carrier hotels and the networks that are closer to the consumer that are multi-tenant and they're obviously are far less costly and take far less power. I mean, it seems like that just seems like such a safer bet to me.
Yeah, I think the obvious answer is people are flocking to the credit quality of the underlying tenancy. And if I've got a 15-year lease from a hyperscaler, I efficiently have a bond against that hyperscaler. And, we know what their credit price is for in the market. And so I can sell on this lease, I can sell on this income stream at some premium to their credit in the market. And, there's perceived liquidity to that.
If you have the right grocery anchored retail, property that's, with all high-end houses built around it, and they're going to shop there because it's in proximity, you're going to find the retailers to come in there.
Well, amen. And I surely love that sector of real estate quite a lot, quite a lot in that sector for all those reasons. But I also think just, discerning the credit quality of tenants in that hoteling model today, when they're largely startup type businesses, when they're largely venture backed type businesses, some of which may be the Googles of tomorrow and some of which may be gone tomorrow.
Well, I'm talking about the trading companies, the Verizons, the network providers too.
And I think that's pretty good business if you can do it and you can do it with edge. I just think it's hard. I think, finding the sites is hard. Securing the power is hard. Building the technological infrastructure in an urban environment is hard. And so superpower to the people who can do that really well. I have a lot of respect for that. I back to the other thing we said was sort of foundational is, being obsessed with competitive advantage. I'm not the best in the world at doing that. And so, we should leave it to the people who are. And, there's plenty of places where we can go build a competitive edge that's a little less volatile and a little less sort of tip of the spear at the moment.
So when you think about competitive advantage for what you're doing, what do you, is finding the right partner or building the right platform a key part of that? And how do you decide when to build a platform versus, do a joint venture with an existing operating partner? And how do you think about the longevity of those relationships?
Yeah, I think, again, it's all rooted in the thematic, the ask why until you can't ask why anymore. If we really get our heads behind what's changing, why it's changing, how likely it is to keep changing, well, then two things I think become apparent. One is what it takes to win with those changes. One of the things I say is sort of the process of asking why is a little bit like, shrinking the buy box to its tightest possible expression. I love when you talked about grocery anchored retail, you inherently shrunk the buy box to sort of high net worth neighborhoods of infill locations with credit quality tenants. Like you described a buy box for me that's fairly precise. And that, by the way, happens to be our buy box in grocery. So I think it's a good one.